What's going on, my fellow wealth creators? Matty Ice here. Welcome back to another episode of IUL Fantasyland, where we are going to take a trip back to TikTok, kind of the main primary playground for IUL agents right now. And we're just going to debunk some of the BS that is thrown out there and just kind of bring the conversation back to reality. So I've been called anti-IUL many times, and I'm actually not. I'm anti-misrepresentation. I'm anti-bullshit. I'm anti-overhyping something just to sell it. I want people to make informed decisions. I'm not anti-IUL. If you want to buy an IUL, as long as you understand what you're actually getting into, you have an agent that knows what they're doing. You know how the product works. You know the risks that you're taking. You know the things that can be changed in the contract, and you want to roll the dice. Go for it, man. Do whatever you want. But let's be real. The majority of people have no idea what they're buying. And a lot of these agents don't even know what they're selling. Some of the stuff they say is just absolutely insane. And so that's what we're going to do today. I just want you guys to understand the risk involved with these products, the things that can go wrong. And here's why I'm so passionate about this, is because I almost dumped a lot of money into an index universal life policy. Thank God I didn't, and I continue to do my research because as I learned more about how the product actually works, not what was being told to me or taught, how it actually works, I wanted absolutely nothing to do with it. I went with custom designed, high cash value, dividend paying whole life insurance. That was a really, really good fit for me for what I was looking to do to implement infinite banking and all that stuff. I wanted nothing to do with an IUL afterwards. That might not be the case for you. You might not come to the same conclusion. But how can you get to that conclusion at all if, like, deciding whether or not this is good for you if you don't have all the information? If you don't understand how these things actually work. So, and you're just buying it based off of the illustration and what people like, the influencers that we're going to go through here, what they tell you, like, you got to understand how these things actually work. So let's have some fun. Let's see what this gentleman has to say. Let me back this up here. There we go. Oops. All right, let's start over. All right, let's have some fun.
Let's take a look at how an IUL works very simply. So we have John. John is you, me, whoever. John is going to be you today, okay? So John goes and earns money. John takes his money and he goes and purchases a life insurance contract known as an indexed universal life. So let's say he takes $1,000 from his monthly income that he generates at work, right? He puts this money into an insurance company's contract. A small percentage of that is going to go towards an immediate death benefit. God forbid something happens to John right away, it'll pay out to his family. If he gets cancer, stroke, heart attack, brain aneurysm, anything like that, he has access to these funds while he's also alive.
All right, so all that's fine. Death benefit, obviously, it's life insurance. If he were to pass away unexpectedly, then the money would go to his beneficiaries. And then if he were to get diagnosed with a chronic critical terminal illness, you can accelerate. It's called an accelerated death benefit rider. You can accelerate a large portion of the death benefit to get the care that you want, need. I mean, you could really do whatever you want with it. So all of that is correct so far.
But let's just say a little bit's going to go to the cost of that. The remaining amount of his money, which is the majority of it, over 90% of his funds, usually go towards an accumulation account, okay? This accumulation account is linked to an external index, such as the S&P 500, BNP, Barclays, NASDAQ, whatever you think. 7 to 10% is the average rate of return. There could be years of 20%, 30%, depending if it's uncapped or not.
Okay. I would love to know where he gets those numbers. Where are you getting that from? It's going to average 7 to 10%. So first off, that's a pretty wide range. So is it 7, 8? Is it 10? Like, what's the defining factor there? What makes the difference? I would love to see an IUL that is averaging 10% since inception, and not a policy that's been enforced for 3-4 years, whatever. I'm talking about one that's been enforced because these are long-term decisions that we're making here with these types of products, guys. So I want to see an IUL that's doing 10% every single year since the person started the policy. I would love to see that. All right. So if you guys know about that, if you have that, drop a comment down below. I would love to get you on the channel, or just send the policy to me. I would love to see it. Okay. Because this is the kind of stuff that just really aggravates me, because that sounds really good, right? Getting 7 to 10% average every single year. That is just not going to happen, guys. And when he's talking about with uncapped indexes, all right, again, the uncapped index sounds really good, but what kind of uncapped index are we talking about? Are we talking about uncapped S&P 500? Are we talking about uncapped on one of these crappy proprietary volatility controlled indexes? Whatever. I mean, stay far away from those things. I've done tons of videos on those guys. Be really, really careful with those types of indexes. But let's say it's an uncapped index on the S&P 500. Again, show me a contract where it's guaranteed to not have some type of cap on it. Like, what's the participation rate? What are the spread charges? What are the no risk rates? Like all these other things that are likely involved with an uncapped index that will hinder the amount of interest that you're able to earn. So again, these are just questions you have to ask, things that you need to be aware of. And it can be very, very misleading when you hear somebody say that you can get 7 to 10% average in an uncapped index. Sometimes you make 20%. I mean, is that really? And also, how many times is that really going to happen? How many of these things that the life insurance company can change within the contract are going to impact the ability for the policy to do that long term, right? So let's just be realistic with these types of things, guys. And also, I want to clarify about this accumulation account that he is talking about. All right. So here's how it generally works with premium. Okay, when you make premium in an IUL, he is right that a portion is going to go to the cost of insurance. There's other costs, expenses, whatnot, and then there's also a large portion. There's going to be a large portion that goes into the general fund of the life insurance company. That's where they invest the premiums very conservatively. Usually, it's primarily made up of bonds. So it's kind of like you're getting access to a big bond portfolio. There's other investments that the life insurance company makes, but the idea is that the life insurance company is taking a portion of the premium, investing it to generate a return that's going to support death claims and all this stuff. If you're with a mutually owned life insurance company and you have a whole life policy like I do, you participate in that profitability via a dividend. But in this case, with an IUL, what they do is they take that return that's created from the general fund. That's what creates the options budget to go purchase options on these indexes. Let's say like the S&P 500. And that's how you get exposure to the market without the downside, because if the market tanks, well, the options just expire worthless. You weren't actually invested in the market. Of course, there's still cost of insurance, expenses, other fees, etc. So your cash value will take a hit for that. But a lot of times that can be managed. That's not usually the biggest issue here. But the biggest issue is just the misleading nature of how these things work. And they're made to be like they're very simple. It's actually very complicated. So there's an options budget that's generated by the general fund of the life insurance company. That's used to go buy options on the index. Okay, there's two things. There's two very important factors to understand that can be changed, that can impact the performance or the amount of interest that you get in your IUL. The options budget can change, and the cost of those options can go up as well. So if interest rates are lowered again, for example, usually lower interest rate environment means that the general fund of a life insurance company isn't going to do as good, because again, they're primarily invested in safe assets like these bonds, right? So if interest rates go down, that's going to impact the performance of the general fund, right? Well, that means a lower options budget, so they're not able to purchase as many options on the index. What does that do to the amount of interest you're able to earn in your IUL? Well, that's where you see things like cap rates and participation rates and spread charges and all this stuff starts to get changed based off what the options budget is and the cost of those options. What happens when there's a lot of volatility in the market like we've seen recently? Options get very expensive. So you might have a decent options budget, but now that the options cost twice as much, how many options are you able to buy, right? And so the point is, those things are completely outside of your control and can have a significant impact on the long-term performance of the IUL. Now, is that a deal breaker? Not necessarily. Okay, but you better understand how that actually works, and that there's a lot more to this product than just putting money into 90% of your money into an accumulation account, and you're going to get 7 to 10% average for the rest of your life. No, not going. It's just probably not going to happen, guys. Let's use some common sense and be a little more realistic here. Let's continue.
But let's say an average rate of return of 7 to 10%. This account is linked to an index. It's not invested in the index, so therefore it's not subject to market volatility. John can never lose money. It's essentially a savings account on steroids.
Not true at all. You will lose money in an IUL when you have that 0 year, because there's still costs and expenses that need to be paid within the policy. Where does that come from? If you have a 0 year, if you're not earning interest to cover those costs, where's it coming from? It's coming from your pocket. So it's coming from your cash value. So you can absolutely lose money. And what they'll say is, oh, well, those are just expenses. Okay, Fair, but because you're not technically losing money in the stock market. Okay, I get that. But when I don't know about you guys, but when I hear somebody say I can never lose money, that means my account value cannot go down at all, not even a penny. That's what I think of. Okay, kind of like a whole life policy is guaranteed to grow every single year. It cannot go backwards unless you're a dummy with it and you lapse the policy with too many policy loans and you're just being a dummy with it. But that's beside the point. A whole life policy is guaranteed to grow every single year. Okay, with an IUL, it's not guaranteed to grow every single year. You could get a 0 year. You're going to go backwards. And granted, it's because of costs and fees. It's not because of the market. So what? You're still going backwards. And again, is that a deal breaker? No. But as long as you understand it, like if you buy this thing with the expectation that you will never lose money, and then your cash value goes backwards, you're probably going to be pretty pissed off. You're going to be confused at the very least. Like, hey, I thought I couldn't lose money. I thought I couldn't go backwards in this thing, and yet that's exactly what I did. So that's really important to understand. And then he's calling this a savings account on steroids. That's absolutely not true. An IUL is really an investment alternative. It's not a savings alternative. Whole life is going to be your really good savings account on steroids because it's a very safe asset. IUL is not. It's not. It's very hard to predict exactly what it's going to do because there's so many things that can be changed within the policy, and you can have that 0 year. I don't know. The last time I checked, savings accounts don't go backwards. So I don't think this is a very good savings alternative. It could be an investment alternative. Like if you want to reduce the volatility in your portfolio, you want upside potential, downside protection, whatever. Maybe this is an investment alternative, even though it's life insurance. But the way I hear agents talk about this thing, it sure sounds a lot like an investment to me. But it's certainly, in my opinion, not even close to a savings account. Not even close.
Right? So he only participates in market gains, never loses any money. He's protected for his family with a little portion of his contributions. But this account is going to keep compounding and growing over time. This money pushes over into what we call.
It doesn't compound. If you can go backwards, which you will, that's not compounding. Compounding is uninterrupted growth for the life of that financial vehicle, like a whole life policy, right? But these things are not going to compound. When you have a 0 year and your cash value goes backwards, and here's one way to counter that, guys, is if you have a portion of your premium put into the fixed account, and maybe you're getting like 1% guaranteed. Now, that doesn't mean you're guaranteed to grow 1% every year. It just means that you're guaranteed to get a little bit of interest every year that could cover the cost of the policy. That would be generally a good way to do it. But now you have less money in the indexing option. So is your policy going to grow as much? Is it going to look as good on paper? Probably not. All right. But as long as you understand it, that's fine. But you're not compounding. Like when you have a 0 year, you've lost that year of growth, but you've also lost the impact of that growth would have over the next 30, 40 years. We're talking about a significant amount of money being lost. It's just lost opportunity cost because the policy did not grow that year. So when you hear compounding with an IUL, again, I just think it's very misleading because they don't compound. When you have a 0 year and your policy doesn't grow, that's not compounding. So
called a cash value account or John's bank. This is where John can take money out of this policy at any time in his life. Does not matter. He doesn't have to be 59 and a half like Joe, who has a 401k, right? John went and got the IUL, so he could touch his money whenever he wants for whatever he wants with no questions asked, right? So this cash value account keeps growing because the accumulation account keeps spilling over. And when John wants to borrow from it, John takes a tax.
Okay. So again, a lot of that is true where he's talking about policy loans, all right, which you could take a policy loan for any reason. You don't need permission to do it. It's like legally in the contract that they have to give you the policy loan, right? You don't have to wait till you're 59 and a half like you would a 401k. All right. That's like IUL agents love to compare the 401ks why IUL is so much better than a 401k, which is why it's bizarre to hear somebody say that this is a really good savings account on steroids when they're comparing it to 401ks, which is an investment account. So like, which one is it, dude? IUL is an investment alternative, potentially. Not a very good one if you ask me. But yeah, you could take policy loans. All right. But here's the thing. Again, you have to be careful with this kind of stuff. So number one, how much cash value do you have access to? All right, that's a really important question to ask, and it's based off of your surrender value within the policy. A lot of these IULs have very long surrender periods, so you don't actually have access to a lot of your cash value for quite some time. And we're talking about like your break even point being like 8, 9, 10 years, where the amount you're able to borrow against equals how much you've put in. So again, is that a deal breaker? Maybe not, but you need to be aware of that. Like, how much cash value do you actually have? So I think he was talking about like putting $1,000 a month into this thing. Well, are you going to have access to even close to $1,000 a month, or is it going to be years until you start to have access to a decent amount of your money because of the surrender charges? That's another thing to be aware of. Okay. And then I don't want to get into the rabbit hole too much about borrowing for like infinite banking, which is a horrible idea in my opinion with IUL, but particularly like retirement income using participating loans for retirement income. Oh my God, guys, please be really careful with that. That's probably a separate video, but anyways, yeah, just be careful with the surrender charges and like how much you're like find out how much you're actually able to borrow against. All right, let's continue.
Free loan from his cash value account. He's like, hey, I have this cash in my account. So he goes to the insurance company. He's like, hey, will you guys give me a loan because you could collateralize it with the cash in my account? And then the insurance company is like, yeah, here you go, John. Here's a loan. Go do whatever you want. And if you die, it's okay because we know we'll pay it off with the cash in your account. And it's also backed by a death benefit, right? So this whole cycle just keeps rinsing and repeating. And if John wants to pay the loan back, if John wants to reverse this and pay his loan back, he's putting it back in his cash account. Therefore, he could access it again. And all while this is happening, it's never touching the accumulation account. So therefore, this account that has like $1,000,000 in it, $100,000, whatever the amount is, that is still fully indexed, still getting the rate of return because he didn't borrow from that. He borrowed from the insurance company who collateralized it with the cash value in his account. Therefore, he's getting uninterrupted compounding growth. One of the only vehicles in the world that allows him to do this, right? And he gets to do it tax free.
Okay. All right. I believe that's the end of it. So yeah, again, the uninterrupted tax-free compound growth. You're not getting uninterrupted compound growth, guys. The stock market does not go up every single year. So what are you talking about? It's not doing that. Now, again, is it a deal breaker if you have a 0 year and then the next year maybe you earn 10% in interest credit? No, it's not a deal breaker. But stop telling people they're getting uninterrupted growth because that's not happening. The stock market doesn't go up every single year, guys. I just like that seems pretty basic, like pretty common sense to me. Now, let's see. You know, I think that was it. Like, about the policy loan. I do want to finish up on this, where he's talking about the the policy loan. Like, if you were to pass away with this policy loan, the death benefit would pay it off, right? And that's true. Be careful with that, though. Like, I just want to be careful with the language, the language around this, because oftentimes people get the misunderstanding that you don't ever have to pay back a policy loan. And that's very dangerous, especially in the beginning years of a policy. If you're using the policy for retirement income, obviously it doesn't really make sense to pay that policy loan back because you're taking policy loans for income, right? You want to be careful with that. That's a whole other video, but that would be one scenario where maybe you're not paying the policy loan back. You just have to be really careful with it. However, in the beginning stages of the policy, let's say you're trying to, an emergency comes up, you're trying to implement infinite banking with this thing, which I do not recommend at all. You absolutely want to pay that policy loan back because that's going to compound against you if you don't, and it could eventually lapse the policy. The other thing you have to be careful with IULs when borrowing against them to do something like infinite banking is what happens again when you have a 0 year. Well, you have that interest cost now that is now added to the expense, or like to whatever it is you borrowed against the policy for. So you're not getting growth in the policy that year to help cover the interest cost. You have to factor that in to the equation as well. So these things are not necessarily deal breakers, but you have to be, in my opinion, you have to be aware of them. Otherwise, you've got a lot of different things here that can just kind of blindside you and potentially make you question like whether or not you would have actually put your money into this thing in the first place had you known about the different aspects, the different things that could potentially go wrong. It could be changed within the contract that might not be so beneficial to you as the policyholder. So anyways, we'll go ahead and wrap up with that, guys. I hope that was helpful. I hope it was informative. I just want you guys to be careful. There's a lot of this kind of stuff out there. It's not to say to not purchase an IUL, but just if you're going to do it, be informed. Like make sure it's an actual educated decision. You're putting your money into something that you actually understand, and it's a good fit for your particular goals. All right. So hope that was helpful. Any questions, drop them down in the comments section below. Talk to you guys in the next one. To your success. Matty S is out.